You're listening to Kerry Lutz's Financial Survival Network, where you get valuable information you just can't find anywhere else. To thrive in today's trying times, you need the Financial Survival Network, now more than ever. Go to financialsurvivalnetwork.com and get your free newsletter and gift. Financial Survival Network, now more than ever.
Welcome. You are listening to the Financial Survival Network. I'm Kerry Lutz. Today is 3/10/21. Well, interest rates shouldn't be any secret, are heading higher. How much higher will they go? That's the question. And for that answer, we're turning to our good friend, Wolf Richter, over at wolfstreet.com. Highly recommended. It's entertaining and extremely informative. I check in on it quite often. And if you got any opinions on where these rates are heading, I'd like to hear. Just send us an email to kl@kerrylutz.com. So, Wolf, you've kind of been following all of the financial news, all of the trends with a, would call it somewhat jaundiced eye. Skeptical, as always, which is why we like to check in with you periodically. Where are we now? Where are we heading?
Hi, Kerry. Thanks for having me. The interest rate thing is interesting on many levels. The short-term rates are still near zero, solidly locked down by the Fed. And the long-term rates were heading that way, too. And there were predictions back last summer that the 10-year Treasury yield would drop below zero and become negative, as similar sovereign debt had done in Europe already and in Japan. And so there were a lot of bets being placed on this. And you've got to remember that when yields go down, they go down because the bond prices rise. And so for people betting on yields declining, they're taking long positions in these bonds and hoping that they get a higher price when they sell them. And these are highly leveraged positions and complicated trades often. So there's a huge amount of bets based on that. And then in August, yields turn around and the 10-year yield went from 0.5%, so from 0.5% on up. And, it's now close to 1.6%. So it tripled over the space of half a year. And this is a fairly significant move, and there's a lot of money been lost. I mean, if you just have a long-term Treasury bond fund in your portfolio or exchange-traded fund, you'll be down 16, 18, 20% maybe in terms of the share price. So this has been a kind of a bloodletting in the bond market. And interestingly, the Fed has spoken with a unified voice on this, and they have said, essentially, as long as this is orderly, we see it as a sign of rising inflation expectations and a growing economy, and we want both of those. And so we're fine with rising long-term yields. And Powell has confirmed that on Thursday. Then interestingly, on Friday, Janet Yellen, Secretary of the Treasury, chimed in and said the same thing. They're all speaking of the same. They're all singing of the same hymn sheet. It's a sign of growth and a sign of rising inflation expectations, and that's what we want, and therefore this is good. So for now, the Fed is on record of sort of encouraging long-term yields to rise as long as it's not too sudden and not too far. And so this is an entirely different scenario than 6 or 8 months ago. And why are they doing this? And in part, possibly because, they keep buying assets. So these long-term yields are rising despite asset purchases. So despite the Fed's buying mortgage-backed securities and Treasury securities, which include a lot of long-term paper. And so this would normally push down long-term rates, but they're coming up despite of these purchases. The way I see this is as the Fed's mild way of sort of putting a damper on the markets that have completely gone out of whack. The housing market, the bond market, the junk bond market is still going crazy. It's not been influenced by that at all. I mean, the junk bond yields are still near record lows. Mortgage rates have come up, so this is going to pressure the housing market just a little bit. And we've seen some of the impact already on the stock market. So I think the Fed is trying to tamp down on the exuberance in the financial markets in a way without really doing anything. They're just letting it happen without changing their own monetary policy. The monetary policy is still zero interest rate and QE. So now the question you ask is, how far will this go? And this can go, in theory, this could go pretty far if inflation rises, if inflation expectations continue to rise, and if actual inflation is measured by the various measurements that we have rises. So at some point, the Fed will say, no, this is enough. And it won't, it will step in to keep long-term rates from rising further. I don't know what that point is, but that's the big question. Where is that point? Is it at 2% for the 10-year yield? So we're at 1.6 nearly now. Or is it at 3%? 3% 10-year yield would mean mortgage rates in the 4.5% range, and that will be really tough on the housing market. So currently, I think if it goes to 2%, that will already be a very big move, and it will have a big impact on a lot of things, and from housing to obviously the bond market, the stock market. And a lot of leveraged positions will come undone, which will trigger a lot of selling in various ways. And you've already seen some of those ripple effects in the markets of rising yields. And it's not just bondholders. These are hedge funds that have complicated trades with huge positions on one side or the other of it. And these disruptions have major impact on all kinds of financial assets, and so we've seen some of that. And at some point, this could become disorderly. And the Fed has pointed out several times that it doesn't want disorderly. And so it's, if things get disorderly, it'll unleash its QE or whatever it will do, buy long-term bonds and sell short-term securities, that kind of thing. And this could happen, but we're not there yet. So I think there is room for rates to rise if they rise in a gradual manner, and if it's orderly, quote unquote orderly. Powell said he's fine with that so long as it's orderly.
Yeah.
So if something blows up, they'll step in.
Yeah. Oh man. But the ability of the Fed to control the future. Do we give it too much credit to be able to do that, or is this reasonable?
Well, in theory, the Fed has unlimited buying power. It creates its own ability to buy, and we've seen the Bank of Japan do this for 2 decades now. And even though the Japanese economy and society is completely different than ours, and there's a lot of support mechanisms they have in place to keep that from going out of whack. But so we may not be able to duplicate what the Japanese are doing, but they have a lot of resources to buy. Now, what they cannot control necessarily easily is inflation and is the currency. And so at some point, you will see an impact on the currency in terms of inflation.
Yeah,
we've already had we've had a lot of inflation already, and we've had asset price inflation out the wazoo, and that's a big factor. We had housing inflation that's not accounted for properly in the CPI. About a third of the CPI, the Consumer Price Index, is housing, but it's based on rental prices, and it's not based on house prices. So it underestimates the house price inflation in terms of what consumers are paying. And, so the inflation data we're looking at, we only have 2% inflation. Well, that's not how the expense in your life rises. You're going to be spending a lot more than 2% in terms of price increases, but it's just, that's what we're looking at. So they have caused a lot of inflation already. It's just not being properly documented in our inflation indices that we use. So if they're looking at consumer price inflation of 3% and CPI of 3%, that means that their own inflation measure will hit about 2%, and that's kind of the target. And they're going to let it run over. So 3.5%, 4%. This is going to be tough. And for a few months it's fine. It's not going to have a huge impact, but if this continues, 4% inflation, the way it is being measured now, it would be very, very tough to deal with for an economy. And it's the purchasing power of labor gets diminished by that. It's the purchasing power of the dollar that gets diminished with inflation. So people that earn money in dollars, they see the purchasing power go down. The creditors are good with that, but the debtors are good with that, people that have a lot of debt, or companies especially, but if they can raise the prices. But in terms of consumers, this is a difficult situation. And if wages don't come up at least as much, you'll see consumers, especially at the low end, that they'll have to cut back because they can't afford the higher prices anymore.
That's an interesting issue that you raised, because we haven't dealt with inflation as an issue, an economic issue, in probably 20, 30 years, even though it's been there, but it's been handled in such a way that it's not apparent. But wages and individual incomes generally lag inflation substantially, certainly in the beginning and into the middle. And then towards the end of the inflationary cycle, they start to catch up and exceed. But then again, the economy is fundamentally different than it used to be. I mean, we could be dealing with inflation in way different terms, and it could get higher too, right? I mean, all this stimulus money floating around, all of these monetization of debt, which basically goes into the bank's pockets. When rates start increasing, banks start lending more, right?
Don't just survive, thrive. The Financial Survival Network.
Trilogy Metals is a world-class developer in Alaska's Ambler Mining District. The company already possesses 8 billion pounds of copper, 3 billion pounds of zinc, over 1 million gold-equivalent ounces, and now over 77 million pounds of cobalt. Trilogy's Arctic project boasts an after-tax net present value of $1.4 billion with a 33% IRR. Trilogy is led by an experienced management team with proven success in discovering and developing projects in Alaska. The company is well capitalized, has no debt, and possesses strong institutional support. Trilogy trades on the New York and Toronto exchanges under the ticker symbol TMQ. To learn more, go to trilogymetals.com. That's trilogymetals.com.
This is the Financial Survival Network, the information you need to thrive now more than ever.
Yeah, if there's demand for loans, and there may well be. I mean, we'll have to see that. Right now, everyone is awash in money, and the consumers are borrowing, companies are borrowing, so that's already taking place. I don't know how much bigger that's going to get.
You can always use another flat screen, right? Well, or maybe a fleet of Teslas, because since we're not going to have any ICE engines and Tesla is going to own the world. All these things come into play. As far as precious metals, is the new inflationary cycle going to see precious metals go up, or are we going to see it kind of stagger around where it's been, kind of going lower on a bearish intermediate trend since its peak in August 7th of last year? So the question is, precious metals, they're going to be a beneficiary of this?
Yeah, as you pointed out, I think they've already been a beneficiary of this. And they had a pretty big run-up going into the last summer. And when you look at the numbers, that's pretty big, so they could have accounted for the future inflation pressures that way. It's really hard to I mean, you would think that markets are forward-looking, and if they see inflation coming up on the horizon, they will react before they get there. And this could have been the reaction by precious metals to the inflation scenario we're now looking at. And that could be one explanation. I mean, they've had a huge run-up into last summer and like 2 years worth of increases, and it. This could be that's the reaction we already had. It's already baked into the cake. So that could be one explanation. On the other hand, if inflation turns out to be bigger and badder than we estimate now in official terms, there could be another run up in precious metals to account for that. There's a lot of interest switching from precious metals to cryptocurrencies, and I think that has taken out some of the steam from precious metals, and there are people that have switched and sold the gold and bought Bitcoin, that kind of stuff, so there may be some rotation there too, even though it's completely the opposite. Actually, I don't know why people do that, but
why do people, why do they do anything? Why are they hoarding toilet paper when the world's coming to an end? I don't quite understand any of it. Well, I do. It's emotional, and the cool thing about crypto is. One of the things I find really cool about it, and people accuse me of being a crypto basher, which I'm not, but one of the cool things is they trade purely on emotion. There is no underlying anything. You don't look at production. You don't look at, things you'd look at for a stock or for a commodity. None of that applies to cryptos. Strictly emotion equals supply and demand, right?
Yeah, and that's the design. The people that came up with this wanted to have something that couldn't be compared to anything, and so that the price would float around there, and as you pointed out, in its own universe. There's no PE ratio, there's no revenues, there's no yield, no dividends, nothing. Yeah. So the price could be anything from zero to infinity in theory. And the idea is to make supply limited, but it's really unlimited because there's thousands of cryptos out there now, and some of them are fairly big, and of course Bitcoin is the biggest. But there are all these copycats out there, and there's now quite a bit of information coming out that Silicon Valley has been behind this for many, many years, and that this is kind of there's this Bitcoin mafia out there of Silicon Valley people, and Bloomberg put that together, and these are billionaires, that have pushed this concept of creating something that is nothing and selling it for some amount of dollars, and then getting all the funds to buy into it, and they've succeeded. They've gotten a lot.
Brilliant.
Yeah, it's brilliant. And I mean, when you think about it, there's no upper limit. The lower limit is zero. The upper limit is infinity. And so if you have enough powerful voices pushing this, prices will go up. And if enough hedge funds and enough pension funds and enough asset managers buy this stuff, the result is that the price is going to go up. And this is, in a way, this is a genius. It's not illegal. It's not doing anything, not violating any law or anything. So there's no prospectus, or there's you don't jump through the hoops of Wall Street. So
hey, we just started a new coin. It's called the Ponzi coin, and in honor of Charles Ponzi, we've bought up large swaths of swampland in Florida that can never be built upon or developed, but it is an asset, and it's asset backed. So I think we should do pretty well on it.
Yeah, I mean, some of those choke coins have done exceeding well. I'm thinking about doing my own too.
The Wolf Richter coin, or the
Wolf coin,
Street,
yeah.
The Wolf Street coin. I think there's something to it, and a special offer to existing viewers of wolfstreet.com. You can get in on the ground floor of this, because basically now you can buy crypto blockchain software infrastructure off the shelf, pretty much base it on Ethereum, and anybody can do it. It reminds me of Murray Rothbard. He always used to talk about competing currencies, and he would say, instead of dollars, we're going to have Rothbards. And now we can have Rothbards and trade them to our heart's content.
Yeah, and then when you think about it, there's more cryptos out there now than there are stocks in the United States. So over a span of a few years, that's how they have multiplied.
Yeah, I love it. I mean, there's a genius behind it. And when you talk about Silicon Valley, we all know the big ones. We're talking Facebook, we're talking Amazon, and Google. We all know there is a certain government entity behind the rise of all of these Silicon Valley titans. Not to play conspiracy theorist, but this is pretty well documented over time, and you just have to look, and you can see it. So hey, everything works out for the best. I mean, that's the kind of market we're into now, and that's what the large, vast majority of the masses believe, that somehow it's all going to work out for the best.
Yeah, I mean, that's what the hope is.
Yeah, well, reality, though. We have this thing called reality. Well, hey, you're advising Joe Sixpack or Steve Chardonnay what to buy in. Buy cryptos, buy precious metals, stay in the stock market, buy real estate?
Well, the issue now is that all asset prices have been inflated dramatically, with the exception of some, there's some exceptions, but you look at the general categories of cryptos, they've gone completely nuts. The stocks have gone nuts. The bonds have gotten hammered. The high quality bonds have gotten hammered recently, but the junk bonds are still out there in the crazy sphere. So it's very tough to recommend buying anything right now because everything is so risky at this point. Everything is so overvalued, and if you buy now, you're buying into the hope that they'll be even more overvalued in the future, and that could be the case. But this is I think it's a very tough time to tell people to buy anything. I think there's good case to be made for hanging on to stuff that you have. If you buy a productive asset, so if you buy a business or a building or something that will produce something, a rental building or a factory or a farm, that's another thing where you have more control. But I mean, even farmland has gotten incredibly expensive, and in some of the industrial sectors, so warehousing has gotten incredibly expensive.
Sure.
Offices, though, you may get a deal on an office tower, if you can handle 70% vacancies, and so it is right now. I think it's very tough to recommend really to buy anything. It's just it's a high risk environment. I've never seen a riskier investment environment than right now.
Yeah, you and me both. But let's just say you got kids, younger kids, and you want to put money away for their college. All right, or for them to start a business, because I don't know that college really is going to exist in its present form in another 10 years. There's certainly an argument to be made that it's going to change dramatically, especially when I can go study the theory of relativity from the most brilliant minds in the physics sciences, in physics. I can do it for nothing now, and yet I'm going to pay $60,000 a year, $75,000. It's going to be interesting to see. Society's changing so fast, and that's maybe what makes investing more risky than it ever has been, in addition to assets being overbought, overvalued, and the fact that that money is just pouring into everything now. Eventually, the party ends. And I know you'll be telling us about that when it happens. So we go over to wolfstreet.com and we'll check you out. I urge everybody to sign up. Wolf is must reading. I love your irreverent tone, Wolf, and your insightful knowledge here into what's going on.
Hey, thank you, Kerry.
Hey, well, thank you. We'll talk to you again real soon. And happy, safe, sane investing to all of you out there.
Thanks for listening to Kerry Lutz's Financial Survival Network, your solution to today's trying times. For the latest, go to financialsurvivalnetwork.com. Financial Survival Network. Now, more than ever.